Welcome to Chapter 14, Investing in Mutual Funds. Investments for the masses. One of the tricky parts of teaching investments is should you do stocks and bonds before you do mutual funds, or should you do mutual funds before you do stocks and bonds? In the Introduction to Investments class, we do mutual funds before we get to stocks and bonds. Now, we've done a little bit of an overview of the investment universe, as we did in Chapter 11, in Chapter 1 of the Introduction to Investments class. But we really want to hammer away at mutual funds right at the beginning because we know we're going to lose a lot of students. Here we are, 2/3, 3/4 into the semester of Principles of Money Management, and you're still around, so we're doing stocks and bonds before mutual funds because it really makes more sense to discuss the investments that go inside mutual funds before you discuss mutual funds. But that's just a little bit of trivia in case any day in the future you wind up teaching investments. Okay, so there's a little bit of a tip from the somebody who's been doing it for over 20 years now. Okay, fine. Let's get started on slide number 1. Mutual funds will bore you to wealth. What a great saying! Isn't that a great saying? The cocktail party, mutual funds aren't the most exciting topic. More people talk about how many shares of NVIDIA they own. But it's not bad to be bored to wealth, is it? Yeah, indeed. And once you've chosen the mutual fund, there's not a whole lot more you need to do. Just make sure the money comes out of your paycheck or out of your checking account for your Roth IRA or whatever, a regular account. Yeah. Of course, you need to review them every 6 months, a year or so. But reality is most of us are too darn busy, and many people just don't really enjoy investing in stocks, doing all the legwork it takes. And also, bonds are kind of hard to invest in unless we got tens of thousands, hundreds of thousands of dollars. So for the vast majority of us working grunts, mutual funds are indeed investments for the masses. Now, one last thing on this slide number 1, if you're looking at slide number 1, the real name of mutual funds is investment companies. Yeah, that's the real name. And I like that a whole lot better than mutual fund. ETFs, you've heard of those, index funds, mutual funds, they're all investment companies. And then there are a few other flavors of the darn things. But that says it all, doesn't it? A mutual fund, yeah, I guess the idea of, we're all getting in this together, mutual. But investment companies is, that's what this company does. You want shoes, you go to a shoe company. You want insurance, you go to an insurance company. You want a car, you go to a car company. You want investments, go to an investment company. Cool. So let us start with what is a mutual fund on slide number 2. It's an investment chosen by people who pool their money to buy stocks, bonds, and other financial securities, which is a fancy word for financial investments. As we said, the legal term is investment company. Now you get 2 wonderful things: professional money management and instant diversification. There's some controversy over whether these professional money managers are actually worth their, because they get paid pretty well. And, some are, and some aren't. It's kind of like teachers and doctors and lawyers and mechanics and plumbers and the like. Some people are very good at what they do and other people, okay. Anyway, each fund has a specific objective, financial objective, and there are over 12,000 funds to choose from. Wait a minute. When you go in the grocery store, are there 12,000 different breakfast cereals? It might seem that way, doesn't it? Are there 12,000 different types of cars to buy? Why are there 12,000 mutual funds? Well, there's some reasons that we get into a little bit later on, but these things are very profitable, folks. They're not for profit. They are for profit enterprises, and it can be very lucrative. Many people, as we said, are going to choose mutual funds for their retirement accounts, your 401k, your 403b, out of your paycheck, the traditional IRA, the Roth IRA, out of your checking account once a month, whatever, or if you have a bonus or something like that. We'll discuss these in detail in Chapter 16, our last chapter, Retirement and Estate Planning. But know that these are very cool things. And you're going to see some stuff, especially if you nose around these financial websites. 401ks are horrible. Like, right, buddy. Yeah, what do you want me to do? They want you to sign up and buy gold from them or something. Slide number 3. Do you like this graph? I did this graph. Now, one of my students actually did a much more professional graph for me. Thank you very much. And we use it in 123. But I still like my really bad graph. I'm really good at stick figures, don't you think? Here we are. We're the little people. And more of them are women. And because they're not relying on the man of the house anymore, because they saw what happened with grandma, because grandfather said, "Don't worry, little lady, I'll take care of you." And he didn't know what he was doing. He didn't save a dime for retirement. And then he died. So women are saying, "Okay, guys, we'll take over from here. Thank you very much, ladies, because we need it." And we give our $50, $100 a month, if we can afford it. And we give it to the people in the top hats. These are the mutual fund managers. And notice more and more of them are that's a woman, by the way. Okay. And it turns out, statistically, it's already been shown that women are better investors than men. Now, I will leave it onto you to decide why that is. I'm not even going to touch that with a 10-foot pole. But women are better investors than men. They are. It's already been statistically shown. And what these managers do is they create a pool of money, and I know it looks kind of like a potato, but it's supposed to be a pool. That's why it's called a mutual fund, the legal term investment company. And these people have millions, billions of dollars to invest. And so if they invest in stocks, it's called a stock mutual fund. Funny how that works, right? If they invest in bonds, it's called a bond mutual fund. And if they invest in the short-term vehicles, short-term instruments, that we normally call cash. It's not really cash. They have names like treasury bills and corporate paper, commercial paper, bankers' acceptance notes. These things might as well be cash. It's called a money market mutual fund. So it's very similar to a checking account at a bank, but it usually pays you a lot more, but it's not guaranteed. Right, that's the big difference, right? It might as well be. And by the way, you don't hear people say money market mutual fund. They just say money market. But they don't buy 5 or 10 stocks like you and I might do, or 20. They buy 200 stocks or 500 bonds. Yeah. So because they got billions of dollars. So you see instant diversification. Your $100 buys 25 cents of Apple, 30 cents of Home Depot, 10 cents of Nike. Yeah. That's why they're so cool. You allow them to do the legwork, the research work. And, if they're doing it right, it's not cheap. You need people all around the world because the world is global, speaking many different languages, knowing the cultures and the like. Yeah. And we're going to see there's a bit of a backlash against that research called index funds. We'll see that later on. Now, here we begin to see the huge explosion of different types of mutual funds with what's called a balance fund. A balance fund invests in both in stocks and bonds. And that's just the beginning of all the different types and flavors and, oh my goodness, of different types of mutual funds. And that's why we have 12,000 of the darn things. But cool. So keep this graph in your mind when you think about mutual funds. The 3 major categories of financial investments: stocks, bonds, and short-term instruments, usually called cash. We should put little quotes around this thing here. And the mutual fund managers take our money and invest it for us. We get 2 wonderful things: instant diversification and professional money management. Okay, so why do investors purchase mutual funds? So as we said, you get the professional money management. You have to understand and research and read about the fund's manager or managers. That's what I prefer. A mutual fund that has several managers. You see, these people, they become sometimes like professional athletes or celebrities. If they do really well, then they get showered with love and attention and a whole lot of money. What I'm more interested in personally is not a star manager. Although there's some really good managers. Wait, I'm going to ask you to take a look at the Contra Fund, this Fidelity Contra Fund. But I look for companies that are more team-oriented. They work together as a team. Now, they make their own decisions. It's not a committee where everybody has to agree. Forget that. Forget that stuff. No, they make their own decisions, but they work together as a team. And then if one person leaves, it doesn't destroy the continuity. This Fidelity Contra Fund that I've just mentioned is a phenomenal fund, folks. It's part of the assignment. It's one of the funds to take a look at. But the problem is the gentleman who's been running it since 1992, I think, he's genius. I've listened to him speak. He's really smart. But he's getting up there in age, kind of like yours truly. So eventually he's going to have to retire. And then Fidelity, the company who runs the fund, who sponsors the fund, is going to have a tough time filling his shoes. That's the problem with the star manager system. And then we said you get instant diversification. The investors' funds are pooled and used to purchase a variety of investments, not just 10 stocks, but 100 or 200 stocks. This variety provides some safety that is difficult for individual investors to obtain on their own. Now, if you nose around the financial websites, or if you watch the telly or whatever, or read anything, you're going to come across people who really don't like diversification. And you know what? That's fine for them, but it's a two-edged sword. If you don't diversify, you may do really, really well if you just choose a few really good investments. But it may turn out badly for you. It might be the other side. So, I'm a big fan of diversification. I think diversification is good. Now, the last reason we choose mutual funds, I wish I had come up with this. I didn't. The wealthy barber again, David Chilton. Thank you very much, Mr. Chilton. He called it the PETA factor. Pain in the... Yeah. Right. Once you've chosen the mutual fund, which is the hardest part of mutual funds, by the way, once you've chosen the mutual fund, then there's not much you need to do. As we said, you make sure the money comes out of your paycheck for the 401k, the 403b, out of your checking account for your regular account or your Roth IRA or traditional IRA. Yeah, that's your job. Yeah, and then of course, as we said, you monitor them on a not a daily basis, please, but every 3-6 months, a year, even sometimes. If it's a mutual fund that has been around for decades and has done well, and good times and bad, and we're going to see some of these at the end of our discussion in chapter 14. So look at the growth of the mutual fund industry. In 1940, when the Investment Company Act of 1940 was created, yes, the demagogues and Republicans can work together in the sandbox. They can play nice and get things done. Before that, there were mutual funds, but they really weren't regulated well, and the states and the IRS were kind of scratching their heads like, what do we do with these things? So finally, the Congress acted, and there were 70. 30 years later, there was 350. Then 600, but look at the explosion. In the 1980s, the competition just started to get very fierce, and as the markets went in two directions, up and way up. And then between 1990 and 2000, there were 9,000 mutual funds. And since then, we've added another over 3,000. And the 2004 fact book, the Investment Company Institute, for those of you who are, bookworms and data hounds, this comes out in May. So for 2023, we know that there were 12,288 mutual funds. So, the 2025 book will come out in May of 2025, and we'll know the information for 2024 then. So you see, the industry is huge. Now the mutual funds are the largest financial intermediary in front of banks and life insurance companies. In other words, they hold on to more people's money than any other entity in the financial world. Yeah, they're huge. How do you purchase a mutual fund? Well, you can go through a broker. Now, you're going to pay some way, either by a commission or assets under management, which is the new way to charge your clients. You can go directly to the investment company, and some of them are very good marketers, like Fidelity, like Vanguard. But in my humble opinion, the best way, whether you go through a broker or directly through the investment company, is to use auto contribution from your payroll, checking account. And we're going to see a technique called dollar cost averaging. Really bad name, but a really good strategy. Don't worry about what's going on in the marketplace. Just put $50 a month away, $100 a month away, and let the mutual fund do its thing. How do you sell? Well, again, if you have a representative, a broker, or whatever you want to call us, or directly through the mutual fund. And in my humble opinion, the best way is through automatic withdrawals into your checking account electronically. See, now here's the deal. Okay, here's the deal. All right. You automatically invest $50, $100 a month for 30 or 40 years, and we're going to see some illustrations. You've already seen some. And by the way, those were mutual funds back in chapters 12 and 13. And then you automatically withdraw $2,000 or $3,000 per month for the rest of your life. Is that a deal? Huh? Is that a deal? Wait a minute. Did I mention there are no guarantees? Yeah, our lawyers said to say that. Always be sure to read the fine print. Okay. The prospectus that nobody reads that tells you about all the dangers. And in the illustrations, you saw the be afraid, be very afraid. Investments are not FD. No, these are not a bank, folks. Now, if you go into a bank and you tell them you want to get a better return, they might move you over to a corner of the bank that says investments. And there's a guy or a gal in a really nice spiffy suit. And you've left the bank. You are no longer dealing with Wells Fargo. You are now dealing with Wells Fargo advisors. You're no longer dealing with your credit union. You're now dealing with, I think they still use CUSO. I forget what it stands for. Credit Union Security, something or other. And this is where some confusion. People think that they're still with the bank, even though they're not with the bank anymore. They're with a sister company, shares the same name. And so when it goes down, they go, wait a minute, I thought it was guaranteed. They said, no, we gave you all the materials that you didn't read to tell you that it could go down, right? So do be careful. Okay, now fees. We spend a ton of time in the Introduction to Investments class learning about the different fees of mutual funds. Because, why? Because these are not nonprofit organizations, folks. They're not doing this for their health. I mean, obviously they're doing it for their health because if you don't eat, you get sick. But no, they are out to make a profit. And some are very, very lucrative. So we need to understand the fees. And most people don't. They know they're being charged. They just don't really understand. There are what are called annual operating expenses that are charged yearly on a percentage of the fund's asset value. What does that mean? Okay, say you have $100. If they charge 1%, that means every year they're going to take $1. Now, that's after. Before the return that they report to you is after they've taken out that $1. So they take out the $1 before they. It's just part of the operation of the mutual fund. Before they tell you, hey, we did 10% last year, or we did 11%, or whatever. They range from very low, 0.05 or less, especially with these newfangled things. Well, they're not that newfangled. They're 50 years old now. Index funds to more than 2%. Ugh. So that's which is actually less than what the life insurance companies and the banks charge you, folks, by the way. So that would be 0.5% would be 50 cents on $100. 2% would be $2, right? Yeah. Some have extremely low fees, which we're going to see when we take a look at index funds and ETFs. Those really, but you got to be careful. Now some ETFs have higher fees because it's confusing. But some that don't do any research. Remember the people in the top hats? Some of the funds just get rid of those people. You or I could run the fund because all we do is look at a list of stocks and buy it if it's on a list and don't buy if it's not on a list. Now, if you go to a financial representative, you may be asked to buy a sales load, buy a fund which has a sales load, pay a commission, a sales commission, charge. This is the original old way of charging your clients. The new modern day go-go way is to charge them assets under management. which means tack another 1% on top of the 1% that the mutual fund is charging. And so that is actually not my favorite cup of tea. I don't think it's in the best interest of the clients. If you want to buy the fund from me and you want my advice, I'll show you a commission-based. Now, having said that, if a person wants to change their fund every few years, no, you want to go with the assets under management, because then you're going to wind up spending a ton of money either way. But the assets under management model, because they're charging you in perpetuity, like that word perpetuity, it means forever, until as long as you have the fund, you wind up spending a lot more. And I get a lot of flack from people in the industry because this is the way that most brokers work now. They want to charge you assets under management. I remember, I can tell you this story. I'll tell it to you. How much am I doing? Not doing bad for time. I was this was when the transition was still happening. People were still selling the old commission-based, and some of us still do. And a lot of more people were moving to assets under management. And we were at this seminar. We were all suited up, and I do have a suit, folks. I actually have more than one. And we were talking about this phenomenon that was going on at the time. This is about 15 years ago or so. And I said, it was my turn. I said, I don't really believe that the assets under management is in the best interest of our long-term clients. Assuming they're buy and hold clients, yeah, they're going to spend a whole lot more with the assets under management. Of course, as I said, if they want to buy and sell, sure, you're going to spend a lot of money either way, so it doesn't matter. And this guy in this really, really nice suit with perfect hair, beautiful teeth, he just looks at me and says, "What are you worried about? You send them a bottle of wine on their birthday, take them to the steakhouse, to the golf course, they'll love you." And I'm usually not one to keep my mouth shut when I'm when I'm confronted with an obvious I didn't know what to say, so I just kept my mouth shut. Like, okay, that's how you feel about your clients. You don't care about you more care about you. Yeah, okay. So be careful. And in the Business 123 Introduction Investments class, we really, really hammer this idea of how much you're going to spend if you just pay the commission, and how much you're going to spend if you don't. Now, if you go with the assets under management. Now, if you believe that you can be your own asset manager, you can be your own financial advisor, then of course you're not going to pay either one. You're going to go with no-load funds. But be careful. Some no-load funds have high fees, annual operating expenses, and some have very high annual operating expenses. So you really, really have to dig deeply, and most people don't, sadly. So here are the different types of load funds and no-load funds. And again, in the 123 class, we really hammer this idea. We ask our students to remember this. I'm going to ask you to remember it, and of course, right after the exam, you'll forget it. But it's very important, especially because you're going to be the financial expert guru for your friends and family and colleagues, right? Of course, right. Now, the very first mutual funds had what was called a front-end load, and they are now called Class A, although some companies call them Class 1. I don't know if what was for Franklin? I don't know if they still do. I think they call them Class A now. Class A shares have an upfront fee, but they have lower annual operating expenses in perpetuity. I love that word, in perpetuity. You get to spit on your friends when you say it. In perpetuity, forever. People said, but I don't really want to pay that upfront fee. No problem. For you, we have the Class B shares. Back end fee. We'll charge you if you take the money out, when you take the money out. And you might say, well, wait a minute, Ms. Broker, Mr. Broker. That doesn't sound like a good deal. Relax. What difference does it make if you charge me up front or about the back? The back end mutual funds have a contingent deferred sales charge. What a great name, right? It just means the first year they'll charge you 5%, second year 4%, 3%, 2%, 1%, until finally they don't pay you they don't charge you anything. Are you with me? Annuities have that same kind of contingent deferred sales charge. They call it a surrender charge. but they start at 25%. It takes or 20%. Takes you 20 years to get rid of that back end fee. So how does the broker make money then? They will charge you higher annual operating expenses for 4, 6, 8 years, and then they revert to the A shares, which have the lower annual operating expenses. The B shares have become persona non gratis. They're not as popular as they used to be. Then what used to be pretty popular were called these broker no-load funds. No, Securities Exchange Commission said, no. You have to call these load funds. They don't have an upfront fee. They don't have a back-end fee, but they have higher annual fees for 10 years or sometimes in perpetuity. They are called Class C shares. And the Securities and Exchange Commission said, look, all you're doing is amortizing, which is a fancy word for stretching out financially. You're stretching out the commission over 10 years or whatever. So you can't call them no-load funds anymore. Brokers can't do that anymore. They can't call them broker no-load funds. Okay, so those are the types of load funds. What about the types of no-load funds? Well, the advisor no-load funds, the Class F, the Class FI, the Class I shares, sometimes called the clean shares as opposed to dirty shares. These are the assets under management funds I was telling you about, where they don't charge you an upfront fee, they don't charge you a back-end fee, the mutual funds have very low annual operating expenses, but the advisor then tacks on an extra 1 up to 2% to manage the account. Assets under management, wealth management fee. We're not your brokers. Oh, no, we're your wealth managers. Well, dear students, first of all, they don't even want you unless you have $50,000 or $100,000. Now you hear people say you got to have $500,000 to invest. You're going to wind up spending a whole lot more with the assets under management than if you just paid the commission and been done with it. But hey, what can I say? I'm in the minority here. Then the financial industry, the financial media calls them true no-load funds. These are, that's not a legal term at all. They just call them true no-load funds because they have no upfront fee, no back-end fee, and there's no advisor involved. There's no broker involved. So there's no assets under management fee for the broker. And they may not have a 12B1 fee greater than 0.2. What is this 12B1 fee? Well, unlike life insurance companies and banks, mutual fund companies, because of the Investment Act of 1940, must tell you what they are doing with their money. They must break down the fees. And one of the fee is called the 12B1 fee. And it's a fee that is used to market the fund, to advertise the fund, distribute the fund. Does Coca-Cola have to tell you how much of every drink you drink is part of their advertising budget? No. Do banks or life insurance companies have to tell you how much they spend on those stadiums that they sponsor? No, but mutual fund companies do. But again, with a no-load fund, even with a no 12B1 fee or a very low 12B1 fee or very low no commissions or whatever, the annual operating expenses, if they are high, and some are, can wind up costing you more in fees than a load fund. So you really need to break it down. And this is all I'm going to ask. We're going to ask you to remember for this class. Know that you're being charged. Know it's an annual operating expense and maybe a commission and maybe an assets under management fee. But in the introduction to investments class, we really, really want the students to understand this because you are going to be the financial guru for your friends and family and coworkers, and they're going to be the investment gurus, those students, and hopefully we'll see you next semester in Business 123, Introduction to Investments. Of course, all the material is free of charge, folks, on the website. Cool? What do you think of mutual funds so far? Much easier? Right. Once we've chosen a mutual fund, and the PETA factor is very low. So go back over and make sure you understand this. You have any questions on these types of load funds and no load funds, contact me, because next presentation, oh my goodness, we're going to try to do that which is undoable and get our arms around this 800-pound marshmallow, which is the mutual fund industry, and take a look at what types of mutual funds are available to you. Cool? Thank you, as always, for being in our class. Think of how much you've learned. We are so proud of you, dear students.